Picture this. It's 2026. Your portfolio drops 30% overnight. Banks are scrambling. Headlines scream crisis. Sound familiar? Before you panic, let me show you what the world's top financial institutions are actually saying. I'm here to cut through the noise and give you the facts. No clickbait, no conspiracy theories. Just verified data from the IMF, Federal Reserve, European Central Bank, and World Economic Forum. By the end of this video, you'll understand the real risks we face in 2026 and what makes today fundamentally different from 2008. Quick note, this video is for informational and educational purposes only and is not financial advice. Always do your own research and consult qualified professionals before making any financial decisions. Let's start with 2008, because everyone's comparing everything to it. The 2008 financial crisis wasn't just a bad day on Wall Street. It was a systemic meltdown caused by very specific problems. First, banks were massively overleveraged. They were making risky bets with money they didn't have, sometimes 30 to 40 times their actual capital. Second, subprime mortgages. Banks bundled terrible loans into complex securities, rated them AAA, and sold them worldwide. When homeowners defaulted, the whole house of cards collapsed. Third, zero regulation of shadow banking. Institutions like Lehman Brothers operated outside traditional oversight, taking enormous risks nobody was watching. Fourth, interconnected contagion. When one bank failed, it triggered a domino effect because institutions were so intertwined. The result? Nearly 9 million Americans lost their jobs. Global GDP contracted. Entire economies needed bailouts. It took nearly a decade for trust in banks to recover. In fact, according to Gallup, confidence in banks only returned to pre-crisis levels in 2025. Here's where it gets interesting. According to the latest data from major financial institutions, 2026 looks fundamentally different. Let me break down why. The Federal Reserve's April 2025 Financial Stability Report states clearly, the banking sector remained sound and resilient overall, and most banks continue to report capital levels well above regulatory requirements. What does that mean in plain English? Banks today hold much more capital as a safety buffer. The 2025 EU-wide stress test, which simulates a severe global recession, confirmed that euro area banks are adequately capitalized to withstand major shocks. The European Central Bank's November 2025 Financial Stability Review adds, euro area banks maintained robust return on equity levels, averaging close to 10% in the first half of 2025. They're profitable, well-capitalized, and liquid. That's a stark contrast to 2008. After 2008, regulators built guardrails. Basel III requirements force banks to hold higher quality capital. Stress tests happen annually. Dodd-Frank introduced systemic risk oversight in the U.S. The banking system isn't perfect, but it's far more supervised than in 2008. Here's something crucial. According to the Fed, household debt relative to GDP is subdued relative to recent history. Most household debt is owed by borrowers with strong credit histories who are well positioned to meet their payment obligations. Translation? Most people have fixed-rate mortgages locked in at low rates from 2020-2022. Debt service ratios are slightly below pre-pandemic levels. Yes, credit card and auto loan delinquencies are higher for non-prime borrowers, but we're not seeing the widespread mortgage defaults that triggered 2008. The IMF's January 2026 World Economic Outlook projects global growth at 3.3% for 2026 and 3.2% for 2027. That's not booming, but it's stable. The euro area showed resilience in the first 3 quarters of 2025. Inflation is moderating. Headline inflation has fallen sharply from 2022 peaks, stabilizing close to the ECB's 2% target. This isn't an economy on the brink of collapse. It's an economy navigating challenges. So if the fundamentals are stronger, why are people worried? Let me be clear. Just because we're not facing a 2008-style meltdown doesn't mean there are no risks. The World Economic Forum's Global Risks Report 2026 surveyed over 1,300 experts worldwide, and they identified several genuine concerns. This is the #1 risk identified for 2026. What does it mean? Countries are using economic tools as weapons: tariffs, sanctions, export controls, strategic resource restrictions. The WEF report states, geoeconomic confrontation threatens the core of the interconnected global economy. Trade policy uncertainty spiked in early 2025 with new U.S. tariffs, though it has eased somewhat with recent agreements. But uncertainty remains elevated by historical standards. For context, effective U.S. tariff rates increased significantly in 2025. While some deals have been reached, including a U.S.-EU agreement, the full economic impact will unfold over time. This creates business uncertainty, which can dampen investment and growth. Global debt has surged to nearly $346 trillion according to recent estimates. That's a staggering number. In advanced economies, total debt to GDP stands at 110%. Countries like Japan are at 230%, France faces fiscal pressures, and even the US has concerning deficit levels. The ECB notes, fiscal fundamentals are on greatly differing trajectories across countries and remain particularly weak in some. Some euro area countries still run sizable budget deficits despite progress since the pandemic. Here's why this matters. High debt limits governments' ability to respond to future crises. If interest rates stay elevated, debt service costs eat up more of budgets. Market confidence can shift quickly if investors doubt a country's ability to pay. But, and this is important, high debt doesn't automatically cause a financial crisis. Japan has run massive debt for decades. The question is whether markets lose confidence. So far, sovereign bond markets have absorbed high issuance smoothly, even during turbulent periods. The Fed's April 2025 report states, asset valuations are notable. Prior to early April's market volatility, the ratio of equity prices to earnings had remained near the high end of its historical range. Translation, stock markets, particularly U.S. tech stocks, are expensive. The concentration is striking. A handful of large U.S. tech firms dominate valuations. The ECB notes this leaves global public markets and increasingly also private markets exposed to risks stemming from potential shocks to these firms. Are we in a bubble? Here's the nuanced answer. Unlike the dot-com bubble of 2000, today's hyperscalers have strong earnings, high profit margins, little debt, and diversified businesses beyond AI. They're expensive, but there are fundamental reasons. That said, if expectations for AI-driven productivity gains don't materialize, or if economic conditions deteriorate, markets could correct sharply. The disconnect between elevated uncertainty and benign market pricing suggests potential for sudden sentiment shifts. State-based armed conflict ranks high in risk assessments. Ongoing wars create humanitarian crises, disrupt supply chains, and increase uncertainty. Geopolitical tensions also intersect with geoeconomic confrontation, the weaponization of trade, finance, and technology. This is more technical, but important. Hedge funds, investment funds, and private credit markets have grown significantly. The ECB warns liquidity mismatches in open-ended investment funds and pockets of elevated financial and leverage in some entities could trigger procyclical asset sales and exacerbate market volatility under stress. In plain English, if markets panic, some investment funds might have to sell assets quickly, amplifying downturns. This sector isn't as regulated as traditional banks, creating potential blind spots. So what's the consensus from the world's leading financial institutions? The IMF projects stable growth with manageable risks. Key downside risks include reevaluation of technology expectations and escalation of geopolitical tensions, but they're not predicting crisis. They're highlighting areas to monitor. The Federal Reserve assesses vulnerabilities as notable in asset valuations and financial leverage, but moderate in funding risks and business/household debt. The banking sector is sound. They're watching, not panicking. The European Central Bank states, financial stability vulnerabilities remain elevated given uncertainty over geoeconomic trends, but emphasizes that the banking system has shown resilience to recent shocks, underpinned by strong capital, liquidity, and profitability positions. The World Economic Forum finds that 50% of survey respondents expect a turbulent or stormy outlook over 2 years, increasing to 57% over 10 years. Only 1% expect calm conditions. This reflects elevated uncertainty, but uncertainty isn't the same as inevitable crisis. Here's the key insight. Experts are cautious, not catastrophic. They're identifying risks to monitor and prepare for, not predicting imminent meltdown. There's a huge difference. So what should you actually do with this information? Financial systems are complex. Risks exist, but so do safeguards. The banking system is more resilient than in 2008. Regulation is tighter. Central banks learned hard lessons. That doesn't guarantee perfection, but it matters. Your financial security depends more on your personal situation than global events. Do you have emergency savings, diversified investments, manageable debt, a stable income? These factors matter far more than trying to time markets. Whether it's 2008, 2026, or 2046, basic principles hold. Don't put all your eggs in one basket. Diversify across asset classes and geographies. Have a plan for different scenarios. Secret crash coming. Banks will collapse. Get rich before it's too late. These are red flags. If someone is using extreme language to sell you something, be very cautious. Reputable financial institutions don't communicate that way. Markets fluctuate, crises happen, but historically, well-diversified long-term investors recover. Panic selling usually hurts more than market downturns. If you're investing for retirement decades away, short-term volatility is noise. I can't stress this enough. If you're making significant financial decisions, talk to qualified financial advisors, accountants, and legal professionals who understand your specific situation. YouTube videos, including this one, are for education, not personal advice. So, could another financial crisis happen in 2026? The honest answer is, it's highly unlikely to resemble 2008. The structural weaknesses that caused that crisis, over-leveraged banks, unregulated shadow banking, subprime mortgage contagion, have been addressed. Today's banking system is stronger, better capitalized, and more closely supervised. But are there risks? Absolutely. Geoeconomic tensions, high debt levels, expensive asset valuations, geopolitical conflicts, and non-bank sector vulnerabilities all warrant attention. The global outlook is uncertain. 50% of experts surveyed describe it as turbulent. Here's the balanced view. We're not on the edge of a cliff, but we're navigating choppy waters. The key is to stay informed, avoid panic, and make decisions based on facts, not fear. If you found this analysis helpful, please like and subscribe for more fact-based financial content. Drop a comment if you have questions. I read them all. And remember, this is for education only, not financial advice. Stay informed, stay rational, and stay financially healthy.